Hey folks, David Frost, my strategic forecast. You're here for another episode of Common Sense Market Analysis. Today is Monday, December 4, 2017. We're looking at a daily chart of the SPY or Spider, which is the proxy for the S&P 500. Today, we had a nice gap and crap. Now on Friday, we discussed the fact that the market may get a little bit of a lift early Monday or on Monday in general, but that the market is likely to retest the lows from last week. That's where we left it last week, and that forecast, if you will, still holds true. We got more than a little lift today at the open. In fact, the S&P 500 futures and the Dow futures were up pretty substantially when they opened up Sunday night. They opened at 6 p.m. Sunday evening, and they were up throughout the night and into early Monday morning, but we had a classic gap and crap. Let me go over to an intraday chart, and we'll take a look at exactly what happened. So here's the close from Friday. So we closed here on the Spiders at 264.44. We had a pretty substantial opening today, opening the day at 266.31, up almost $2 or almost 20 points in the S&P 500. And then the market made a top, and you could see the second candle of the day is what I like to call a pseudo doji candle. This is one of the things that's taught in my lazy E-mini trader course. That's a signal of a trend change at hand. It's also a signal of a top in this case, and it certainly holds more water at highs and lows on charts, and this one definitely qualifies as a high on a chart. And then we basically crapped out, and the market went down for the rest of the day. We put in a bearish pattern here, as you can see. We dropped, put in another bearish pattern here, dropped again right into the 100 period moving average, and dropped into the close. That's not a sign of strength. That's not positive by any stretch of the imagination. That's a negative close. When you look at the hourly chart, obviously it's the same routine, but we filled a gap here. As you can see, the gap was at 264.44, which was the close from Friday. We filled the gap and even went lower into the close, finishing below the hourly 20-period moving average, which is the red trend line. This is a negative close, and when we go back to the daily chart, you'll see here that this is basically a reversal candle, a daily chart reversal candle, and that tells me that the probabilities are pretty strong that we're going to go down at least test the lows from last week, and that low comes in at 260.66 on the Spider. Now, what's the significance of that? We had identified that low even before we hit that low last week. We identified it a day before, saying that if the market came down to 260.66, that level is important, and that we should see that level be supportive of the market, which was the case in a very big way. We had a rocket off that level last week, and then we opened higher today, but we had a crap out, and we should come down and at minimum of retest those lows, and we can actually even go slightly lower by the end of this week. Probably not much, but we can go lower. I wouldn't be surprised if we tested the 20-period moving average, which is somewhat of a safety net and comes in right now at just below 260. That number will change throughout the week as the trend line is sloping up, and it's not going to necessarily turn down during this week. Unless, of course, we broke it significantly during the week and went lower. I don't necessarily see that the case. I see that the 20-period moving average and the 260.66 as being relatively close to the number I'm expecting for support this week. Just expecting a retest. Could we go lower? Of course we can. We would have to see how the market's trading at the time. But as it stands right now, on Monday, I'm expecting a retest of this number as we stated on Friday. So as we wrap up the S&P or the Spider chart, everything stays as is. The forecast remains the same. Should get that retest later this week. Now, in the IWM, it's much of the same story. We finished poorly. It looks very similar to the Spider chart, and therefore my expectation is that the IWM will also follow suit on the downside. In fact, the IWM really rolled over today before the Spiders did. Here's your 10-minute chart of the IWM. And you can see the second 10-minute candle of the day. Remember, the spider chart had the second 10-minute candle as even a higher high than the first 10-minute candle, put in a doji, and then it kind of simmered down or slipped down from there before putting in this bearish pattern here and going lower. The IWM rolled over first, and you know what I always say, the IWM is my favorite leading indicator of the markets. It's generally a tip-off of where the major market is headed. We like to follow the IWM on the upside and the downside. It is my favorite leading indicator, and yet again today, it was the leading indicator telling us that downside was coming in the markets as it did roll over first. Now here is a bit of a divergence. My second favorite leading indicator of the markets is the transports. And on the transports, we did make a higher high today. It was up very, very large at the open. We made a high today of 10,504 spot 80 on high. And that's a tremendous gain from where we closed on Friday. But look what happened. We also rolled over in the transports, but we did close at a new high. So that is somewhat of a divergence. My second favorite leading indicator is telling a different story. The transports are very, very bullish. However, also very, very overbought on the daily chart. This has to come back toward home base, or home base has to come up towards price. One of those two things has to happen. So either we go sideways for a while or come down slightly and let the 20-period moving average, which is home base, let that come up into price. That's the red trend line. Or the transports are going to come down with the rest of the market, which is the more likely scenario throughout this week if I'm right about the forecast. But the transports are very strong, and what the transports are telling us that this market is still in a bullish tone, or has a bullish tone, and therefore even with a pullback this week, which isn't going to be all that big of a deal, from where we are now, it's only another, let's say, $4, give or take, in the spider, 40 S&P handles. That's certainly possible. It's not the end of the world. It still holds the bullish trend in place. I just think we're going to retest those lows from last week. And wherever we settle in or come down to in the transports, still will have a bullish tone on the daily chart at minimum in the transports. And even at that, when you look at the weekly chart, okay, so the weekly chart would have to come down extremely in order for the trend, the bullish trend, to be broken in the transports. So even if we came down another several hundred points in the transports, which is certainly feasible to come back and work off some of the overbought condition, on the weekly chart, that's not going to damage the uptrend whatsoever. Looking over at the daily chart of the triple Qs of the Nasdaq, what you can see here is we had that big down day on the 29th of November. We had a couple of days going sideways and then another big down day that was about the same range as the down day from the 29th. And basically, that's market symmetry at work, and that's another thing that's taught in the Lazy E-mini Trader course, as you know. All in all, that's a big decline for the Nasdaq. The Nasdaq 100, the NQ, just to depict this chart here. Let me get that off. Just to give you an idea here, this was more than a 100-point swing. We had about that the other day, and the same thing today. In fact, it was about a 140-point swing from high to low in the Nasdaq 100 market. This is the NQ, represents the Nasdaq 100. Already approaching the lows reached last Friday. So what this tells me is the likelihood, if all the other markets are going to continue down, the likelihood is that the Nasdaq 100, the Nasdaq Composite, any of the Nasdaq-related markets are going to come down farther than the low on Friday. In fact, you have a 50-period moving average here. You also have this breakout point. There's a green candle low. These are important to markets. You have the 100-period moving average underneath. So I wouldn't be surprised to see the Nasdaq 100 come down to 6,100, maybe even 6,000 over the next several days if the entire market is going to have a downturn, as we've been discussing. Tonight, we'll take a look at the financials. The XLF is an exchange-traded fund that tracks the financial index. These are all the big banks and other financial service-related companies comprise this index. And what you'll see here is another divergence. This is in the other direction, similar to the transports. So the transports and the financial sector, I like to look at also the XBD, which is the broker-dealer index, but tonight we'll look at the XLF. They basically trade very similar. It was up about 1.5% today. And what this is telling us, even if the market comes down and the financial sector comes down, that this market overall is still in a bullish tone. And what that means is that even if we come down a little bit, this rally is not over. This raging bull market is not over. It will continue, but we need to come back down and work off some of the overbought condition in some of these markets. As we know, the financial sector is certainly a leading indicator of the markets, both in the upside and the downside. And if the financial sector is not going to sell off of any meaningful magnitude, it's unlikely we're going to get any kind of a meaningful multi-week, even multi-month correction in this market without the financials participating. The financials are going to have to participate if we're going to get a really substantial correction in this market. That's not what the financials are telling us. Therefore, this is not what the market is telling us today. Something could change. The financials could roll over. That's certainly possible, but that's not what the charts are telling us today. What the charts are telling us is that the financial sector is in a raging bull market, in an uptrend on all time frames, and therefore it's unlikely we're going to see any meaningful correction of, say, a 5 or 10% correction in this market. That's not what the market is telling me. It's just telling me that we're going to work off some of the overbought condition in the short term, and if anything further develops, so be it. We'll obviously discuss it here, but that's not what I'm seeing here. I'm just seeing a minor corrective move over the next several days. Switching over to the gold chart, taking a look at gold futures, and what we see here is we're still hovering on the 200 period moving average. And there's no clear picture one way or the other to be able to decipher and tell which way this market is likely going to be headed. We're below the 20 period moving average, the 50, the 100. We're hovering on the 200. If we start closing below the 200 period moving average, then the game is on for the downside. But if this 200 period moving average continues to hold, then the likely scenario is the market's going to want to work its way up higher. The question is, how high can it go? And with a sell-off in the market, you could see a rally develop in gold on the quote-unquote fear trade. However, there's no clear picture one way or the other. And when we don't have a clear picture in any market, whether we're looking at a stock, a commodity, a futures contract, major market, doesn't make any difference. When you don't have a clear picture, the idea is to do nothing. We don't have to create a trade on every chart. We need to let the charts indicate to us that there's a high probability trade setup and therefore it's worth taking a risk with our capital. When we don't see that developing, we leave it alone and we go on to something else where we do see a clear picture developing. Right now, no clear picture in gold, leave it alone. Silver is weak. We ended up closing below the important pivot point of 16.444 in silver on Friday. And therefore, today we maintain below that level. And guess what? Look what the high today was. Let me move this over, and you can see here that today's high was 16.455. We came back up to test that level and failed. That tells us that is now resistance. What was once support becomes resistance. What was once resistance becomes support. That's the way the market works on all charts, all time frames, regardless of the instrument. Silver is weak, telling us lower prices are coming. Where's the next likely target for the downside where you might find a decent level of support for silver? Right around $16. If we get there, then the likely story is that we'll have seen gold also drop along with silver. They don't have to trade in tandem each and every day, but the larger picture is they do tend to trade in tandem the majority of the time in the bigger picture. So if we're going to see a substantial drop in the price of silver, we're likely to see a drop in gold, and we're likely to get below that 200 period moving average. But without a clear picture, you have to leave it alone. And with silver is definitely weak, and 16.444 is resistance just as it was support. And you got a pretty weak bounce off that level anyway once we got there, and that was an indication or a sign of what's to come, and what was to come was more weakness in silver. So you really only got a temporary bounce off that level, that pivot low at 16,444 anyway. And so silver is weak, and therefore the likely story with silver is we come down to the $16 area. Crude oil. We had a pretty good down day in crude oil today, down over 1.5% today, but we're still in a bullish uptrend. We're still above all the moving averages, holding the 20-period moving average. A close below the 20-period moving average would bring some more downside in the price of crude oil. Where would those levels be? If we close the day below, and beginning even hourly, if we begin closing hourly below this 57.20, 57.17 area where the 20-period moving average is, the likely scenario is we'll come down and test the $56.40 area first. And if that didn't hold, then the crude oil market is going to want to go all the way back down to $55. You will get a decent level of support, $54.50 to $55. You have the 50-period moving average sloping up into that price, right now coming in at 54.25. So anywhere between the 50-period moving average and $55, so you have a 75-cent spread there. If this level at 56.40 didn't hold, that would be your new safety net on the downside between the 50-period moving average and $55 a barrel. On the upside, if we did maintain the 20-period moving average on a daily chart closing basis, then higher prices are in the cards, and we can get up into that 60, 60.5 area. And if we get up there, we're going to take a hard look and see, because there could be higher prices coming, but it's way too early to tell. Let's focus right now on this market maintaining the downside. And if the stock market is selling off, there is somewhat of a likelihood that you would also see downward pressure in the crude oil market simultaneously. So we'll see how that unfolds throughout this week. Bonds are hanging in there. This is the 30-year Treasury bond. They're hanging in there in this range. And what this is telling me, as long as we maintain this level above all the moving averages, that this is really working hard to get through this big time top area, or the last time that we made a top here. So here's where it is. So you have a red candle high here, and you've tested it a number of times, and this market is not giving up the ghost so easily. What this tells me is as long as we are above all these moving averages, the 20, 150, and obviously the 200 all the way down here, that this market is going to work hard to get through this resistance point. There's a lot of overhead resistance up in this area. If we can get above there, we tried it on Friday and failed, but if we can get above there on a closing basis, then the bond market is going to want to work its way up here back to double top in this zone, 157, maybe 158. And even though we get up there, if we got up there, it doesn't take the long-term bearish picture off the table for bonds, but they may want to test that area one more time before giving up the ghost. So the outlook hasn't changed in bonds. I still see us making an attempt up at those levels. Doesn't have to happen now, doesn't have to happen tomorrow or the next day, but if it's going to happen, it could happen over the next 2 or 3 month period of time. If we did get up into a double top area, that would represent a wonderful shorting opportunity. We'll obviously have to take a look at it when and if we get up to that area, and see how we get up to that area, and if we put in a signal on the daily chart at minimum of a trend change. Look, you don't have to be the first one to jump in the pool, but if we get up into that area, I will be looking for a short trade in the bond market at that point in time. That would generally be taken with one of the vehicles like an exchange-traded fund such as TLT, maybe a fund like TBT. You would be short TLT because TLT tracks the chart you're looking at now, not necessarily point for point or dollar for dollar. The TLT is the 20 to 30-year Treasury bond exchange-traded fund, and the TBT is a leveraged exchange-traded product. It's not a fund. It's an exchange-traded product that tracks the inverse of the TLT. Not looking at those today, just giving you an idea of what I will be looking at if we get up into this double top area. The last chart we'll take a look at tonight is the Dixie, or the US dollar, and the dollar still cannot get above the 100-period moving average. This is a bearish pattern that is developing, and generally speaking, here's a bearish pattern, down move, sideways wedge pattern. This will generally play out to the downside, another one of those things taught in the Lazy E-mini Trader course, along with a lot of other chart patterns that play out on charts on all time frames, all charts, over and over and over again. So until and unless we can get a substantial move on the upside, and you would have to get above these moving averages and have to close a day above the high right over here in order for the dollar to reverse trend. But right now the trend has reversed lower. It looked like it was reversing to the upside. We've failed. This bullish pattern had failed. Okay, and the fact that it failed, we're coming down, and now we're in a bearish pattern, and this will generally play out to the downside. So your first order of business is, if we do play out to the downside, the likely story is that we come down to double bottom. If that doesn't hold, we're looking down to the roughly 88 cents on the dollar area, where I will be looking to get long once again in the dollar if we got down into that zone. And with that, it's everything I wanted to and intended to discuss tonight, so I'll give it a wrap here. I'm David Frost, my strategic forecast. Thanks for tuning in for another episode of Common Sense Market Analysis.